Welcome to the episode of Doclens.ai podcast. I'm your host, Arnab Dey, CEO and co founder of Doclens.ai. At Doclens, we are devoted to building effective insurance risk assistance, helping insurance companies improve profitability by reducing loss ratios and reducing legal waste. In this podcast, we will hear from experts who have devoted many years in driving better outcomes across multiple industries by effectively using technology, advancements in computer science, and definitely artificial intelligence. I'm really delighted to have Sandeep Tyagi as our first guest in this podcast. Sandeep, welcome. The audience would like to know you, so if you would want to start off by introducing yourself.
Thank you so much, Arnab. Thank you for having me. It's always wonderful to talk to you and wonderful to be a guest on this series. By way of introduction, I am a computer scientist by education. I spend most of my professional career working with numbers, trying to make better decisions using understanding of patterns and stories that the numbers are telling us. I did that mostly for financial institutions, credit card companies, insurance companies, wealth management companies, banking, so on and so forth, and did that both as an consultant, then as an outsourcer of people's decision in an analytics outsourcing company, and most recently for my own self in my latest company where I use numbers to help make investment decisions. So that's a quick summary of my nearly 35 years of work in computer science, analytics, and decision making using data and various methodologies, of which, of course, machine learning is the latest.
Sandeep, that's great. So as you see this new wave of computer science and artificial intelligence, which has become now a household name pretty much, for B2B, what are the most interesting opportunities or priorities that you see, particularly within the banking and financial services and insurance spaces?
Yeah. Look, I think there are two very big trends that I see. The obvious one, which everyone talks about, is what's happening with the world of chat GPT and LLMs, as they are called, large language models. And the second big trend, which has been actually some time in making, but it's only come to fruition more recently, let's say in last 5 years or so, is the types of models that we are building with neural nets in general, but things like transformers and those kinds of technologies in specific. And I'm happy to talk about both briefly. Large language models will fundamentally transform knowledge work, because a very large part of the work that we do in all these skyscrapers in New York City or London or other financial centers is basically transforming knowledge of some kind into another form by using language. So if I am reading somebody's application for a banking loan and then making a decision on whether we should give them a loan or not, well, that's transforming numbers into a particular decision. If I'm looking at somebody's credit card transactions and decide whether that transaction, which has been flagged by my algorithm, is fraudulent or not, I'm looking at a pattern and then converting that pattern into a decision that I may actually validate by talking to the person or by having a conversation with the merchant. These interactions will eventually get replaced by large language models, because for the first time we have the ability to interact with machines in human language, which obviously everybody understands, but the scope of its impact is just simply staggering. The And by the way, I don't think this is very different from what internet was in, say, year roughly 2000. So in year 2000, um, yeah, Yahoo was already there, but Google was not, Facebook was not. Actually, most of the FANG companies were not even established at that time,
That's right.
except obviously Apple. Now, I think we are at that kind of stage because this is so transformative. The older trend of using neural network is a very different trend because when I grew up doing analytics for the first maybe 20 years of my career, there were some very simple rules that we used to follow. Things used to be a simpler model is better than a complicated model, that fewer variables are better than more variables, that explainability of model is extremely important. I remember drawing graph charts to explain to CEOs to say, how does a decision tree make a decision? What variable does it take? And if it is more than a certain amount, then we do X. If it's less than a certain amount, then we do Y. It's just very easily explainable. And that used to be a big deal in terms of making decisions and using technology to make decisions. Well, now the technology has gone so far that forget about explaining it to a CEO or a head of a business. People who are building these models have no idea why the answer is coming out to be the way the answer is coming out to be. Actually, we are putting in tons of variables. We are not taking care of things like collinearity, which used to be a big deal when we were building models using regression and other methodologies. So explainability has gone out of the window. Limited, understandable causal models have been replaced by data mined, over-specified detailed models. And that's a very big change. And for certain types of tasks, they work very well. In general, if your task has many small attributes and the task does not change over time, then these methods will do extremely well. What do I mean? If I'm trying to say, is this a picture of a dog or a cat? Now, the dogs and cats are not changed for thousands of years. And there are lots of small attributes. What kind of hair they have, ear, sizes of eye, face, body, relative body posture. All of those things contribute for us to say whether this is a dog or a cat. Now, this thing can be done by a human being quite well. So a machine can also do it very well if it parameterizes everything. There are some problems where it will not do well. For example, I do investment and trading. Now, even for a human being, it's very difficult, if not impossible, to predict whether the stock prices will go up in the next 1 hour or down. Very difficult for smartest human beings to predict that. So machine also really struggles to do that work. No matter how much data you give it, no matter how much information you give it and how complicated a model you build. We have been working on that for a long time. We understand what machines can do and cannot do. So that's what I will ask your audience to keep in mind. The elements which will continue to get transformed. If you have any human beings in your company that can do any task well, at any kind of scale. I'm not talking about exceptional artists who can draw very well or things like that. But if you have, let's say, 100 people in your company who can do some task well, you can definitely build a machine now which will do that task faster and better. Same, if you have people in your company which do that communication with anybody, vendors, partners, clients, using language, that will also get transformed in the next 20 years. Certainly, and maybe sooner, maybe 3 to 5 years, it will start in a big way.
That's great. And, particularly for our audience in insurance, where it is regulated, explainability is key because your decisions need to be very tightly linked to the source documents or the truthfulness with respect to the ground truth, which is the documents. And that's why understanding um, how honest these models are and their set of metrics are so key. So, very interesting. And you kind of alluded to the fact that you were there when analytics was in its nascent phase, and then it became now again intricately intertwined with every business decisions in financial services. What parallels do you see in terms of positive impact in the language space that AI can have, and what to watch out for?
I think the thing to watch out for in any kind of disruption is that people for whom certain things have worked well have a lot to lose by moving their focus away from it. Let's say you have a process by which you've been making a decision, engaging with a customer, and that has worked well for you. You are a leader in your space. Now, in the Innovator's Dilemma, the book, it talks very eloquently about how that dynamic works. You are very vested in making marginal improvements on that process. So what you will do is you will build expert system which will help your people make decisions. You will make LLM chatbots which will help your customer service reps make better communications or faster communication. But I think the real disruptors will come and just rethink the business process completely. And they will say, okay, maybe this is a skill set I need to develop, but instead of marginally improving my process, can I rethink the process from ground up and completely change the cost dynamics of the industry and make it in a way that it is 1/10 the price of what it used to be, or just like a completely order of magnitude change in terms of the economics of the service. I think those kinds of things have happened in every industry. We all know the stories of digital credit card companies or analytics driven credit card companies or insurance companies or everything that changed any part of the business process and fundamentally rethought about how to do that work, whether it was giving credit to people who were considered not credit worthy and expanding the base dramatically, making a decision purely on analytics, or taking risks which were considered not worth taking, but completely changed the scope by capturing a much larger part of that decision pie so that your risk is actually mitigated through diversification. I think that's what, if I were advising people at this stage on how this would transform, I would focus on is, of course, do the projects to marginally improve your current processes, but have some skunk work project with your personal focus on say, can I build something which is completely going to disrupt this process? We do that in our company. I have my existing team working on trading in a particular way, but we invested in a side team building completely machine learning based models, which was not adding on to our analytical models, but completely going outside it and rebuilding the thing from scratch. I think that kind of an approach of champion challenger with some amount of focus is extremely important.
Take calculated bets on smaller engagements, but which can be very disruptive. Right. So talking about that, because most of our insurance carriers do have a lot of tech debt, and pretty much one new technology comes up every year. Right now, probably in LLM, one new LLM is coming up every quarter or every month very soon. So any observation on how should large companies think about taking advantage of this disruption, particularly when they engage with early stage startups where a lot of the innovation frankly gets done anyway? How should the one end of the very mature with a lot of tech debt work with innovative startups?
It At the end of the day, this is really, I think, CEO's job. The CEO or business leader, if it's a very large company, who's got the overall responsibility, their primary job is resource and capital allocation. They need to pick where to give money and where to give talent to build something, and where to take it away from, where to harvest and generate profits. If you use the current and near-term profit potential as the metric by which you distribute your capital and your talent, you will obviously get disrupted. Because there will be capital and talent available funded by venture capitalists or other sources of talent and capital, which will come in and sweep it from under your feet in terms of building a new and a more efficient business process and a way of doing business. But if you allocate, and I'm not saying it has to be 50-50, I mean, for every business, there'll be a number that is appropriate depending on how much experimentation, innovation is going on in that industry at that time. If you are in, I don't know what is an example of an industry that's not going tremendous innovation, let's say dairy industry, how to produce milk or something like that. And I'm sure people from that industry will have examples of where things are happening. But if the industry is not fundamentally changing, fine, it's okay to give maybe 5% or 2% of your energy and capital to innovative challenges. But in a knowledge work industry, and insurance is 100% capital and knowledge, there is nothing else going on. I think you probably need to be allocating 20% of your money and resources to evaluate, experiment, seed disruptive opportunities and challenges, and that is how you kind of stay abreast. There are examples of companies which have been able to reinvent themselves cycle after cycle, because they've been able to stay on top of whatever is the leading edge change that has happened. The newest example is Microsoft, which people were writing off 10 years ago, and now is leading the charge with all the disruption that's happening with AI and other things through their focus on things that are disrupting them. Same, I think, risk is there for Google. If it doesn't position itself and stays focused on its core search and advertising model, it will get disrupted by somebody like a much more focused answer machine like a ChatGPT is or Perplexity is, which will completely disrupt the whole search ad revenue model. So I think depending on how much innovation is happening in your industry, you allocate disproportionate to profit potential, even next 3-5 year profit potential, to those things to just stay abreast. And maybe some of it will fructify and others will not. Surely many will fail, but there is no alternative but to stay aggressive on that and be a very fast follower. You don't have to invent things, but you got to keep your ear to the ground and see where things are going. And every large company that has now become large has a story when they went to the incumbent and said, buy me out for this small amount, which would have been a fraction of their P&L, whether it was Netflix or Google or Tesla. They all were up at one point or the other looking for an exit. And if somebody had grabbed and had taken a chance disproportionate to the profit that they could see immediately, they would have had a different trajectory to these stories.
Yeah. Some of these language models we see are getting applied in the mortgage industry, and over the years, definitely the mortgage processing industry, for example, has made things a lot more customer friendly. It's definitely not a delight yet, but definitely improvement nonetheless. Switching gears, as we are getting to the end of the podcast, you talked about Innovator's Dilemma, but is that your favorite book? If not, what's your favorite book, Sandeep?
Well, favorite book depends on the type of question one is asking. Factfulness is one of my favorite books. Innovator's Dilemma is my favorite book. Yoga Sutra is my favorite book. It depends on the type of topic I'm thinking about.
Yeah. Favorite leader or personality?
My favorite personality is Warren Buffett. I think he is obviously very well known in the world of investment. But more importantly, I love the joy of life and joy of the work he does. In many conversations, he's talked about how he believes that I think he's 93 or some age like that, that every day he loves dancing to work, I think is the phrase he used, which is something to look forward to and to emulate.
Definitely, definitely, definitely. And what advice will you leave behind for the new folks that are joining the industry, the budding professional working in an insurtech or a fintech? Definitely, dancing to work is a great thing. What would be your advice to them?
Yeah, I think decision making should be done big circle going to the small circle rather than small circle going to the big circle. What I mean by that is pick the broad area you want to work in. Then within that, let's say it is machine learning, for example. Then within that, pick the narrower circle, what kind of industry, what kind of role, then within that, what kind of company, then within that, what kind of title you have, then within that, what kind of salary you're getting paid today. I think many people, especially younger people, make that decision in the opposite direction. They first look at the salary they're going to get. Then they look at, well, how prestigious is this company per se? Then they look at the other aspect. So if I'm getting a job which is paying me a lot of money to, let's say, do a old way of engaging with customers in a very prestigious company, but in a side branch. Let's say you were doing retail banking for Goldman Sachs or whatever example you want to come up with. I think you're making a mistake. You're getting the prestige, you're getting a high salary, but you are not working in the core area for a core company which is doing innovation in that space that you want to be for the long term. On the other hand, if you pick the area and then go deeper, you will have many small opportunities to move and adjust the smaller things. Certainly your comp will catch up to your capabilities. That's the least of your worries when you're making these decisions. If you become worthy of it, people will chase to pay you more. That's not an issue. So yeah, that would be my advice.
Thank you, Sandeep. This was terrific. I'm sure the audience learned a lot from your rich experience that you shared. Thank you, everyone, for listening. We will certainly come back with exciting stuff on a regular basis. And please feel free to write your feedback to arnabday@doclens.ai. Thank you. Have a wonderful rest of the day and a great week ahead. Thanks.
Thank you very much, Arnab.
Thank you.